Hello and welcome to Legal Wrangle on Direct Tax. In today's episode of Legal Wrangle, we bring you 5 important direct tax decisions relating to money laundering, cross-border transactions, the tax impact of transactions with a country declared as an uncooperative jurisdiction for not honoring the Tax Information Exchange Agreement with India. We also have advanced tax and computation of direct and indirect expenses under Section 115 JB. Let's roll into the first case. At a time when banks are under the tax scanner for helping Indians stash funds overseas, the full bench of the High Court has come down heavily on unaccounted money.
This is an Allahabad High Court decision in the case of Gupta and his family.
The High Court ruled in favor of the revenue. The immunity granted to the holder of India development bonds that no questions will be asked on the source of investment will not apply when these bonds were seized as the undisclosed income of the assessee. It will be construed as money laundering. To know what happened, let's go to Maneet.
Yes, Asha. The assessee is an individual resident in India. Tax authorities found foreign currency and foreign exchange bonds during a search conducted on the assessee's premises. The assessee stated that a non-resident Indian had arranged the gift of these India development bonds to the assessee and his family members in consideration of assistance rendered. However, the name of the NRI was not mentioned in any of the documents. Tax authorities concluded that these India development bonds were bogus gifts. This was a case of money laundering in which the assessee had arranged for the bonds and purchased them from his undisclosed income. The question before the full bench of the High Court was whether the immunity provided to the holder of India development bonds under Section 6 or 7 of the Remittances of Foreign Exchange and Investment in Foreign Exchange Bonds Act would extend to the holder of the gifts from an NRI which are later proved to be bogus.
The High Court held that such development bonds seized during search operations as the undisclosed income of the assessees are liable to be treated as a case of money laundering. The verdict went against the assessee.
The Allahabad High Court held that the gift must meet the requirements spelled out in Section 6(1)(a). Thus, immunity granted to a gift holder of foreign exchange bonds does not confer protection in matters which do not fall under Section 6(1).
Talk of the long arm of the law. Carrying on with international issues, our next case relates to cross-border transactions.
This is a Supreme Court decision in the case of GVK Industries.
The key issue in this case is a fallout of the world coming closer and being more connected. Is the assessee liable for deducting TDS on the success fee paid to a non-resident company for assisting the assessee in loan negotiations when the services were rendered from outside India? The verdict went against the assessee. The Apex Court explained the concept of source rule versus residence rule for treating the success fee paid to the non-resident as fee for technical services. I am sure Maneet can throw light on the facts of the case. Over to you, Maneet.
Sure, Asha. GVK Industries is in the business of generation and sale of electricity. It had appointed a foreign company, ABB Projects, as its financial advisors to assist in loan negotiations and documentation. Professional services were rendered from Zurich by correspondence. The non-resident company was paid success fee. The revenue declined to issue the no objection certificate sought by the assessee. The department believed that non-resident company had not only arranged the loans for the assessee but also provided various services in the nature of managerial and consultancy services. Thus, the assessee was held liable to deduct TDS.
Even the High Court dismissed the assessee's writ. and the matter came before the Supreme Court.
The Supreme Court explained the source rule, which allows a state to tax transactions where source of income or payer is located. The court upheld the doctrine of source rule over the residence rule. It also explained the expression fees for technical service with reference to consultancy services.
The Apex Court also considered the question whether the success fee paid to the non-resident would be taxable in India as fee for technical services.
The foreign company had the skill and knowledge in the specialized field, and the nature of its services came under the ambit of consultancy service. The fees paid to the foreign company are taxable as fee for technical service.
Tax was held to be payable even if the recipient of fees was overseas. This decision is a feather in the revenue's cap. Our next case is unusual. When a foreign country does not provide information as requested by Indian authorities under the provisions of the Double Taxation Avoidance Agreement, the Indian government may declare such country as a notified uncooperative jurisdiction under Section 94A of the Income Tax Act. Any person having any transaction connected with a party located in such a notified country may be denied allowance of expenditure. Expro Gulf is the SSC in this case.
Expro Gulf has challenged the notification through which the Indian government declared Cyprus as a notified tax jurisdiction.
The assessee insisted that Cyprus ought not to have been declared as a notified jurisdiction. There was already an international treaty between the governments of India and Cyprus, and Cyprus was bound to exchange information with India under Article 28. Let's turn to Maneet for the facts of the case.
Well, the assessee brought out a press release issued by the Cyprus authorities that they had never denied any information and were ready and willing to supply the information. The question was whether the assessee may file a writ petition on this issue under Article 226 of the Constitution.
The High Court held that the courts ordinarily should not proceed to look into the question whether information sought by Indian authorities was actually declined by Cyprus government.
To what lengths an assessee will go to claim tax benefits? This brings us to our third case. The question before the Bombay High Court was whether a real estate developer following the project completion method is liable to pay advance tax on the parking charges received from its vacant land. The High Court ruled in favor of revenue.
The assessee is Sudhir Borgaonkar, a real estate developer.
The assessee was treated as an assessee in default on account of the parking charges collected from its vacant land and made liable to pay interest under Section 234B. Maneet has the facts of the case on her fingertips.
The assessee is a real estate developer. He had collected parking charges over several years on its vacant land. In view of the project completion method followed by assessee for paying taxes, he had not filed its return of income. This income was declared as miscellaneous income and offered to tax in subsequent year. The assessing officer held that the income received from parking charges was not part of any project and was business income chargeable to tax when assessee had not filed its return. The assessee later accepted the tribunal's order in favor of the revenue that parking income had nothing to do with the assessee's project and was assessable to tax in that year.
However, giving effect to the tribunal order, the assessing officer levied interest under section 234A and 234B for default in payment of advance tax, which the assessee was obliged to pay. The assessee's claim was rejected that there was no occasion to pay advance tax payment as the parking income would have to be returned when the project was completed. The matter came before the High Court.
The High Court held that the assessee is an assessee in default for not paying advance tax on the parking charges received.
Better to be safe than sorry in all tax matters. We now come to the last case of this episode by the Bangalore Tribunal.
This is the case of Sobha developers before the Bangalore Tribunal.
The unusual issue in this case is whether disallowance of both direct and indirect expenses under section 14A is applicable while computing book profits under section 115JB. With a resounding yes, the tribunal ruled in favor of the revenue. Let's go to Maneet for the facts of the case.
The assessee is a property developer for housing projects in Indian metro cities and had shown profits from development and sale of flats on land owned by its sister company. It had claimed the deduction under section 80 IB 10. The assessee had also earned income in the form of dividends on units of mutual funds and share income from a partnership firm. In the view of provision of section 10, clause 35 and 2A, both these incomes were not shown as a part of the assessee's total income. The assessing officer denied the 80 IB deduction and determined the assessee's income and tax payable by applying the provisions of section 115JB. In computing the book profits, the assessing officer made an addition to the expenditure related to earning the exempt income. The disallowance of expenditure under section 14A, read with Rule 8D, was made as per computation of income under the normal provisions of the Act, which had been accepted by the assessee.
The tribunal considered the tricky question whether both direct and indirect expenses may be disallowed for computing the expenditure incurred to earn exempt income.
The tribunal held in favor of the revenue, thus reversing the commissioner's order.
Well, now we have the added clarification that both direct and indirect expenses may be disallowed for computing the minimum alternate tax. Hope you enjoyed this episode of Legal Wrangle. Please email us your comments and suggestions at editor@tiol.in. Do subscribe to our channel on YouTube.